Property prices have been trending up because borrowing costs is just so low right now, correct? Right now, total borrowing cost is about 1.1%. And if you understand how the property game works, it is actually quite easy to get positive cash flow when the borrowing cost is low. So for example, the borrowing cost 1.1% right now, and you get a rental yield of 2.5%, you are likely cash flow positive. That's why property prices usually do well when interest rates are low. Last few quarters, we've seen property prices skyrocket for HDB as well as private properties. So in this cheap money era, many people have actually used the opportunity to take up products and investments using margin. Margin into stocks, margin into universal life plans, margin into annuity plans. And they all make sense because when borrowing cost is low, it's usually good that you can get an investment rate of return that's higher than the cost of funding that you're actually paying the bank to own these investments. But today we're going to discuss whether this era of cheap money is going to end or not. And let me show you some data. The first is this chart over here of the 10-year US Treasury, which heavily influences global borrowing rates. And if you see carefully, it's inched up from 0.8% in August 2021 to right now at 1.566%. Now, a rising interest rate environment means that the economies are doing well. Generally, we have some healthy inflation, and it's not a situation of crisis. And Singapore being such a small economy and being very open, when US reduces its borrowing costs, it tends to impact us also. And let me show you some proof of it. You see over here the SORA rates. SORA is the Singapore overnight rate average, and SORA is now being used for mortgage. What we see is that October and September were at 0.13%, correct? But November is jumped up to 0.155%. Now the million-dollar question is, are we in trouble? Are we seeing a trend of interest rates rising that is real? And the real answer to this is nobody knows for sure. Headlines always shout, inflation is coming. And as we can see in this article by Straits Times, Singapore interest rates may remain low, but for now, the era of cheap money is coming to an end. And they tend to surface whenever there's a data point that springs a bit higher. But let me show you some other data to give you a balancing point of view. In February 2021, interest rates were 0.169% for SORA. In March, it inched up to 0.199%. And lastly, in April 2021, it shot up to 0.221%. And the trend looked for sure. If you look for headlines in April, definitely you see articles of interest rates rising. And indeed, I can show you one, which is done by 99.co. Now that interest rates are rising, how will it affect housing? But the interesting thing to learn from hindsight is that nobody knows for sure. And after April, interest rates actually started to come down against all expectations. In fact, it gradually inched lower to 0.13% in September 2021. Now, I'm not saying that this inch up is definitely a false trend. I'm just saying what has happened in the past might repeat itself. In any case, if you are losing sleep about it, you're really concerned that interest rates will spike, then the logical way is to actually lock in your mortgage. And from the market, I think 5-year lock-ins are about the longest you can find. And DBS is offering something which is at 1.65% per annum if you are borrowing against your HDB. And that leads to a key question for today. Is it better to lock in your rates 5 years moving forward? Or better to still hold on to a floating package? Right now for myself, I can share with you I'm on a floating package. And the cost is about 1.1%. So let's put some perspective to things. If this year's rates are 1.1%, and indeed it inches up slightly, next year 1.4%, then subsequent year 1.7%, then subsequent year 2% and 2% for 5 years in total. The average may not be as bad as 1.65%, even though subsequent years, year 4, year 5 is above that amount. And in any case, there's no stopping you from converting to a fixed package some years down the road even. So the question is, are we better off with a floating, or are we better off locking everything in at 1.65? Because when you lock in, you are paying a premium, correct? Right now, floating is 1.1. But if you lock in, it's 1.65. You're definitely going to pay more in exchange for stability for the next 5 years. So that's why through this podcast, I'd like to hear more opinions. Are you willing to lock in your rates for 5 years? Or you believe that we are still okay floating? Because however it floats, you'll still at worst be maybe 2%. And then that you're better off taking on that risk yourself than getting the bank to guarantee you at a higher rate of 1.65. I believe the crowd has some wisdom, and leave your thoughts and comments in the sections below. I'll be keen to hear from you. And if you have learned something from this podcast, smash the like button and smash the subscribe. I'll see you in the future one. Take care and goodbye.